What if you could lock in a personal pay raise that keeps growing money, even if the stock market is flat? Most people, when they look at a dividend yield on a screen, they believe that that's what they're going to get. But in this video, I'm going to be sharing with you a VIP metric, yield on cost. In order to understand yield on cost, I'm going to be sharing with you my SCHD holdings and DRIP and how they work together to grow your money. Now, I have also invited Henry the Hamster to help navigate us through this. My name is Chelle. Let's dive in. Okay, so now we're in Stock Unlock, and Stock Unlock is a stock planner financial tool, and it's just here to help us. So let's go ahead and look at what they've got for us. So on Stock Unlock here, you'll see dividend yield $1.06, 3.45%. And what that is showing is that this is the new buyer's price. It's the projected payout for the next 12 months for someone buying today. But as long-term investors, we want to move past the new buyer phase. We want to freeze our cost and grow our paycheck.
But how does my position actually grow my paycheck if I'm not adding cash?
It's simple math, Henry. DRIP, Dividend Reinvestment Plan, just means instead of you taking the dividend as cash, you automatically just reinvest into your stock portfolio as it buys more shares. Okay, to understand this more, let's look at this scenario. Imagine you own 100 shares of stock at $100 each. It pays $4 annual dividend, or $1 every quarter. Quarter one, you get $100 in dividends. The magic, your broker takes that $100 and buys one new share. Quarter two, now you own 101 shares. Because you own more shares, your next check isn't $100, it's $101. So basically every single quarter, you are getting more money because you are invested in more shares. So with DRIP, you are investing more in your shares without spending any more of your own money. And that's what's the engine that drives your yield on cost, your YOC. Okay, now you keep hearing me talk about YOC, so let me explain that a little bit more with this illustration. It might make it more clear. To understand why this is so powerful, think about owning a rental house. Imagine you bought a property 10 years ago and your mortgage is locked in at $1,000 a month. Today, the house next door sells for double, and that neighbor's mortgage is $2,500 a month. Even though you both own similar houses, your cost is frozen in the past. When you buy a stock like SCHD at a lower price and hold it, you are freezing your mortgage at that original price. While the company keeps increasing the dividend checks they send you. It's like owning a rental house where the mortgage stays the same, but the rent you collect goes up every single year.
But Chelle, does the market price change things?
Actually, Henry, DRIP is a built-in stabilizer. So what happens is when you reinvest your dividends, if the stock price is lower, the market is lower, so say your average cost basis is $30, you buy in for $20, you're getting more shares. Also, it's going to lower your average cost basis. Now, if it's higher, then yes, you're going to be reinvesting your dividends and not getting as many shares, and your average cost basis will go up, but that means your portfolio is soaring. Now, what's happening with your YOC, as you reinvest your dividends, your yield on cost actually becomes more of a wide gap between you and a new investor. So a new investor is getting at 3.45%. But because you locked in your cost a long time ago, you will have a different YOC. Let me show you using my SCHD. Okay, so we're here back at SCHD. My average price is locked in at $28.85. While a new investor has to pay over $30 to get a 3% return today, my money is already working harder because I started earlier. In 10 years, if SCHD continues to grow its dividend, my personal yield could be 10% or even 15%. Okay, but here's the real kicker. While a new investor starting then might be collecting a $400 check, my paycheck from those same shares could be over $1,200 simply because I let my dividends reinvest and locked in my cost today. That is the power of the head start. Then that is how you finally leave the hamster wheel.
Chelle, look at Main Street Capital. The new investor gets 5.88%, but you only get 5.41%. Is the math broken?
Not at all, Henry. What that just means is that the neighbor's house is on sale, or the stock. And so when I reinvest my dividends, I am now purchasing those shares at that new price, which is going to lower my average cost. And what's going to happen in the future is my YOC is going to be supercharged because now my average cost is even lower. Whether the market is up or down, what truly matters for your financial freedom is yield on cost, your personal cost to you of holding that stock. So what you need to do is keep reinvesting your dividends to lower your average cost basis and just let the dividends continue to grow. That is how you'll leave the hamster wheel. So right now, what is your yield on cost on your favorite stock? Let me know down in the comments below. Henry and I hope that you found this video helpful. Thank you so much for watching. Until next time, bye.